Howdy everybody, and welcome back to another stock analysis video. Today we are going to be analyzing the company Netflix. We have done this company before here on the channel, and they have had a couple rough months in my personal opinion, right? They have been just dragged through the mud with the fact that their guidance was horrible, seeing that they have gotten less people to subscribe, more people have left and all this stuff, and well, seeing that their stock price has fallen a lot, guys. I'm going to show it just a little bit, but seeing that earnings are actually coming out on Tuesday after close, I figured, you know what, let's analyze this company and see if maybe it is a buy right now. So with that said, let's get started with this analysis. Coming right into the calculator, guys, Netflix does not pay out a dividend, which I'm actually really happy they don't, because oh boy, their numbers are awful. We got the ticker symbol of NFLX, market cap of $84 billion, which, by the way, guys, oh my god, I think it was in the upwards of $300 billion last time I analyzed this. This was insane, right? And this actually has a current PE, guys, of 17.16 with a current share price of $189. Now, I did say the share price has fallen a huge amount. Well, if we take a look here at the 52-week range, we can see that the highs that they were almost $701. Current share price, guys, of $189. 52-week low of $162. So we are right at the 52-week low when it comes to Netflix. This is going to be fun. Again, Netflix is one of those examples as to a company that people were like, oh, it'll always go up because innovation, because of this, because of that. And people were like, it'll never go down to like $162 or like $150 or anything like that because it just can't happen. I wonder what those people were saying when it was at $400. It won't fall anymore, right? Well, it certainly did. With the fact that the PE is 17.16, we might consider this buying it at the current share price of $189. Now, they don't pay out a dividend, which means all of their cash flow is going into themselves. However, if you can see right here, yeah, they have no cash flow, guys. They actually have negative cash flow. So that's really, really bad to see. But nonetheless, let's head over to the fundamentals. Starting off, guys, with the net income. This is actually fairly surprising. Their net income is actually going up and at a pretty good rate too, right? 5 years ago of $559 million to 1 year ago of $5.1 billion. That is a massive increase, guys, of 815%. So you can see right here, from 2 years ago, they did $2.76 billion and they shot up to $5.1 billion. I think the reason for this is people were so locked down at around this time, right? 1 year ago, it was when things started to ease up, and I don't necessarily know because last quarter they said that they were projecting a decrease in the amount of subscribers that they were actually projecting. So we might actually see a little bit of a decrease here when it comes to the net income. But as it stands, when it comes to this is looking not that bad. Coming down to the free cash flow, the most important profit metric that we have, because cash flow, guys, is everything. When I say everything, I literally mean everything. This is what a company uses to grow, to buy other companies, right? To make acquisitions, to pay down their debts, to buy back shares, which sometimes they don't buy back shares, which is not something that you want to see, and even to issue a dividend, which they do not issue a dividend. So it's really, really important that the cash flow looks something like the net income. And as you can see, it does not, right? 5 years ago of almost negative $2 billion to 1 year ago of, again, negative $132 million. Ironically enough, guys, we do see one positive number, and that was 2 years ago. But nonetheless, on the 5 year, this is an increase of 93% with a 5 year average free cash flow of negative $1.2 billion. Now, as I said, the one positive number here was 2 years ago. Shocker? Not necessarily. This is actually a COVID number in the opposite direction. Normally, when you see a COVID number, you would see positive, 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 and then slight decrease, and then back to positive. Here is negative, 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 positive, then back to negative. So unfortunately, I have to be consistent with my analysis. Whenever I see a COVID number, I always say ignore it, even though it's a little bit of a decrease. Ignore it because it's COVID related. Well, just because it's positive doesn't mean that I can't ignore it. I have to ignore it because unfortunately, it was a COVID related number. And now lastly, when it comes to the revenue, we got 5 years ago of $11.7 billion to 1 year ago of $29.7 billion. Massive increase of almost 154%. And this is actually one of the best revenues because of the fact that it is increasing year over year and it's also staircasing very, very nicely. However, revenue isn't the most important out of all profit metrics. That would be the cash flow. But you can see right here, net income is kind of doing the same. So is the revenue, but you have to take into account what the company will do in the future. And again, last quarter, guys, they did say that they are projecting a lower subscriber intake than what they were originally projecting. That's why their share price collapsed. So take that into account, and I will certainly take that into account when I make my assumptions. So just be wary of that fact. And not only that, guys, Netflix has a lot of competition. Their moat isn't as strong as you would think, right? They're competing against the big daddy Apple. They're competing against Disney, right? They're competing against Amazon. They're competing against all of these other different streaming service providers that if they don't keep up, they will probably go in the negatives very, very soon. Looking at some balance sheet numbers now, total assets minus the total liabilities. Will they be able to cover their liabilities if they were to liquidate all of their assets? Well, currently, guys, they are able to at $17.5 billion of this difference. And within the past 5 years, they have increased this difference as well. Average total assets is around $34.7 billion. Average liabilities around $24.5 billion. Doing this difference, we get around $10.1 billion. Now, even though total assets minus total liabilities tells us if the company itself might be able to survive with their assets, this does not tell us if their cash flow is able to cover their liabilities. As I said, cash flow is used to pay down their debts, which is part of their liabilities. So usually what we have seen so far when it comes to this metric, companies are mainly in the red, in the negatives, right? But what I like to look for is, are they getting closer and closer to zero? Meaning, are they lowering down their liabilities and increasing their cash flow to the point that their cash flow exceeds their liabilities? If that's the case, then that's great, because that means that in 1 year, they could absolutely they could pay off all their liabilities with just their cash flow alone. So very, very important metric in my personal opinion. And as you can see right here, Netflix is getting worse and worse and worse, right? They are essentially falling deeper and deeper into this difference. Back in the red, currently at negative $28.9 billion, whereas 5 years ago they were at $17.4 billion. Again, all of this is negatives, right? So this is not looking good, because this means that essentially their liabilities is going up, and at the same time, we just saw with their cash flow is going in the negatives as well. So something again to think about when analyzing this company, that their cash flow cannot cover their liabilities at all. Now, if we take the average cash flow and we take the average liabilities and we subtract this, we get negative $25 billion. Now, guys, let's take a look at the metric that companies usually tend to fail. And companies like Netflix, I usually see that they fail because, well, they are growth oriented, right? Companies that are growth oriented, especially tech companies that are growth oriented, tend to issue shares to get that cash in order to fund their projects and all that stuff, right? And even to pay down their debts as well. So looking over here at Netflix, we can see that this is not a surprise at all, right? Increase on the 5 year. 5 years ago, 433.4 million shares to today of 444.3 million shares. On the 5 year, guys, this is an increase of 2.5%. And from the previous year to the current year, this is looking at 1 year ago at 444 million shares to today, as I said, 444.3 million shares. It is an increase of 0.07%. Now, to my surprise, yes, this is an increase, but it's not as bad as an increase as I originally thought. I thought this was going to be a whole lot worse. So this is actually not too bad in my personal opinion. It is still an increase nonetheless. And now looking at the cash and equivalents, they currently have around $6 billion with an average cash of around $5.3 billion. Alright guys, now it's time to use discounted free cash flow to see if maybe $189 after what, like a $500 drop might actually be a pretty decent price to buy it at. So let's actually come over here to Seeking Alpha and see that the revenue growth year over year is around 15.2% and the revenue growth forward is 12.12%. So let's use these numbers to come up with a revenue growth assumption for a low, medium, and high assumption, right? So for the low assumption, let's say a revenue growth, guys, of 8%. For the median assumption, let's say 10%. And for the highest assumption, let's say 12%. Now, you guys are probably saying, That is way below even the forward one. Why is your highest assumption lower than the forward one? Well, my job as an investor, guys, is to be conservative when it comes to my analysis, because I want to take into account everything that could possibly go wrong. And Netflix is a company right now that is not going through a good time at all, so something I definitely need to take into account. So that's why I'm putting these numbers like this. Now, when it comes to the projected share buyback, we just saw the shares outstanding, that they are increasing their shares. However, we need to come up with assumptions to figure out what they will do in the future. So let's say that for the low assumption, that they'll actually issue shares even more, right? At around -3%. The negative just means that they're going to issue, right? So that's the low assumption. For the median assumption, let's say that they'll issue, but they'll issue less at like -1%. And lastly, for the high assumption, let's say that they just don't issue at all, and that they actually start buying back at around 1% or so. So this gives us, guys, the target share prices, not adjusting for debt and adjusting for debt. And as you can see, for the low assumption, this puts me at a target share price of $99.93. For the low assumption. For the median assumption, $109.01, and for the high assumption, it is $118.80. Now adjusting for debt, this is why we take a look at the cash and equivalents, and also when you fill out all the stock fundamentals, there is a part there that says net debt. You have to fill that in because we take the cash and equivalents, we add the net debt, and if they have more debt than cash, then this number comes down, and if they have more cash and equivalents than they do debt, then obviously the number comes up. As you can see, it does come down by around $10 or so for the low assumption of $88.39, for the median assumption $97.24, and for the high assumption $106.79. Now on top of this, I also like to add a margin of safety of 5, 10, and 15%, just in case something bad were to really happen, right? I mean, people thought that it wasn't going to go down below 700, yet at 400, I'm pretty sure they were like, oh my god, it can't go down any further, and the current share price is 189. So we want to take into account all possible scenarios. That's why I like to add a margin of safety of 5, 10, and 15%. And in doing so, for the low assumption, this puts me between a target share price of $75 roughly to around $84 or so. For the median assumption, it is $82.65 to $92.37. And for the highest assumption, it is $90.78 to $101.46. Guys, as it stands, at the current share price of $189, this is still telling me that you still need to wait for this company, assuming that you believe my assumptions right here, which I don't think that they're that far off from the truth, right? Obviously, every investment is the present value of all future cash flow, and none of this is financial advice. As you guys just saw me input all those numbers and everything changed in accordance to the assumptions. You guys should make your own assumptions. That's why I have this calculator available for free, as well as the book value calculator, and even a re-evaluation calculator, and a dividend tracking sheet as well. I'm giving out all this for free. All I'm asking for in return is like, subscribe, comment, help me grow my channel. That's pretty much it. Like, I'm giving you guys free content, free calculators, dividend tracking sheet for free. It's just asking for something free in return. Thank you for everybody who has subscribed so far. Oh my god, I honestly cannot. I just cannot. I don't know. At 1,000, I guess I'll have to do something special. I want to go beyond the live stream. I want to do something special for 1,000 subs, guys. I really, really do. You know, I'm still deciding on that, and I know that we're still a couple hundred of subscribers away, but thank you all so much for those who have subscribed. I greatly appreciate it. It really does mean everything to me. Like, thank you so much. Again, every investment is the present value of all future cash flow, guys. Use these calculators to make your own assumptions. All in all, when it comes to Netflix, this is a company that people were hyping over in 2020, 2021, thinking to the moon. And I think it went the other direction. I think it went the other direction. And honestly, you could have probably foreseen that if you just taken a look at their fundamentals, right? It's not just about news. It's not just about hype. It's not just about the current thing that's happening. You have to take into account everything that they have done in the past, how they have done in the past, and then after you make your assumptions, then take a look at what they're doing in the future to see if they can even do it in the future, right? And unfortunately, Netflix was one of those hype stocks. As I said, the current market cap is $84 billion. I believe the current market cap just last year was over $300 billion. So that's a really, really big difference when it comes to the market cap. So All in all, again, another company I like, doesn't pay a dividend, and it was overpriced, and according to my assumptions, it is still overpriced. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. As I said, you guys can follow me on my new tech sites. The link in the description below. So with that said, peace out. Be on the lookout for the next stock analysis video.